Hello, everyone. Welcome back to the Daily Gold YouTube channel. Thank you so much for joining me. With me today, and this will be published on Monday for Macro Mondays, is Gary Tanashian. He is the editor and publisher of his newsletter, where you can find notes from the rabbit hole. I should say you can find it at nftrh.com. He also started a Substack. He also does some video analysis. You can find him on YouTube. And I shouldn't forget, by the way, as you can see in the background there, Gary plays a mean guitar, but
Not very mean.
that's another conversation. Gary, thank you so much for joining me. How are you today?
I'm doing well. How are you, Jordan?
I'm good. Uh, Gary, I know we're just going to kind of riff here. Obviously, we're talking about the markets, big picture, a lot to talk about with respect to precious metals. But I mean, you tell me, gold and gold stocks, they have been on fire recently, maybe starting to cool off just a bit. Fundamentals to me look pretty good, but you're the expert on gold and gold stock fundamentals. How do you see it right now?
The fundamentals are awesome right now. And in any given week or month, that won't dictate market action, but the fundamentals have not ever been better in my experience, save for maybe the 2001 through 2003 period, which we've been using as an analog for the current situation.
Okay, let's. So you're using 2001 to 2003 as an analog. Let's dig into that a bit deeper. Is that an analog based on the overall market and the economy, or based on gold against the S&P 500? Is just take me through that comparison.
Well, the most interesting part of it is that, or at least to me, the most interesting correlation is that the US dollar is declining at the same time as the gold silver ratio is rising. And that's what happened during that period. Now, we had been trained to expect a rising gold silver ratio to not be so positive for gold stocks, and sometimes not for broad markets, usually not for commodities either. However, back in that phase, the dollar declined, and during the last 20 years after 2003, the dollar had risen with the gold silver ratio. So when risk was going off in the precious metals, those funds would go to gold relative to silver, which is kind of a part-time commodity, part-time precious metal. So on this cycle, that's not happening. Global currencies are gaining a bid relative to the US dollar. You just look at the Swiss franc versus the dollar. It's similar to back then. And gold stocks are rising with the gold silver ratio, which is a blessed situation. It really is. It couldn't get any better than that, because we were trained to expect a rising GSR over the previous 20 years to mean, quite often to mean negativity in the gold sector if silver was not leading and both metals were declining and silver was declining harder. That would be a problem. Right now, both metals are obviously rising, gold much better, and that's just indicative of a disinflationary macro. I think there's a good chance of a deflation scare not too far out ahead. That still remains to be seen, though. But on the biggest picture, we want a countercyclical, anti-inflationary environment to favor gold stocks as a unique sector in the market. And for all too many years, a couple decades, I was not able to really drop the hammer on that view and say, okay, here we go. People ask, when will you pound a table? And for me, it's not until the macro says so in a true way, not a fantasy way or a rose-colored glasses type situation. So that's what's happening now. The dollar is declining. The gold-silver ratio has detached from it in this new era, this new macro. And it's gold is outperforming the stock market soundly. Now the US stock market, the venerable S&P 500, or as I call it, the Teflon Don, the last man standing, has finally succumbed. So it's all systems go, gold versus commodities, gold versus stocks, gold currencies, you name it. And the gold miners are bullish for the right reasons. And again, I'd just add in that, you know, as any fundamentalist knows, the market can go against true fundamentals during any shorter phase. But in the big picture, let's reference Old Turkey from Reminiscences of a Stock Operator. It's a bull market, you know, so pullbacks are a buying opportunity.
I love the quote in that book about how they talked about how old Turkey he would walk, into the shop. Did they call him Old Turkey because of how he walked?
I think maybe it has been decades since I read the book, but Old Turkey stuck with me because I traded myself out of the previous precious metals bull market a few times. You know, I'd sell, take profits. Oh, what a genius. And then be buying back the same stock. Luckily, it worked out because it was a bull market. But this time I'm really trying to be more patient. And yes, it's overbought. Yes, it's at risk. And I'll try to hedge as needed, but that's a hit and miss venture as well. So it's a bull market. And if we're lucky enough to get some pretty strong pullbacks, unless the fundamentals start changing, which they have not hinted to even do yet, then that's when you buy, you get aboard.
Let's talk. I mean, it maybe it's obvious and just extremely the fundamentals between gold and gold stocks, just as an educational point. I mean, I know you say that the gold stocks leverage the fundamentals in gold. Is that, I mean, the because we say, okay, the fundamentals for gold stocks are awesome. I guess, I should put my babbling aside. You said the fundamentals for gold stocks are awesome. So then does that automatically mean the fundamentals for gold are awesome?
Gold stocks. Gold is just doing what gold does in a counter-cyclical environment, and in an environment when what they call the everything bubble is losing its efficacy. Policy is not as effective anymore. Not that they've really tried to turn on the juice, but I don't expect it to be very effective. But the gold stocks have not yet really leveraged gold. So I'm still on a theory. It's not like I can say, oh, look, I've been proven correct. The gold stocks are leveraging, the HUI gold ratio is rising, and, we're all, proven out and beyond reproach. Well, that's not true. My theory hasn't been proven yet. I expect it to be. That the negativity in the investor, the global investor base toward the gold mining industry is in some ways deserved, but I still think the dirty gold mining industry that everybody hates is going to gain that positive leverage because gold is rising versus everything else. The real price of gold is rising, and I think a lot of people are going to be surprised at the performance that relative quality gold mining operations show. But it hasn't happened yet, and I do anticipate it.
So that brings up the question of silver. But I can ask you about silver fundamentals, but I know you look at silver as an indicator, not really its own. I mean, it's more of an indicator than anything else. So, did any comment on fundamentals for silver, or how you see it, or if it's just still an indicator in your view?
It's an indicator. I have some old silver rounds laying around that I will not dispose of. After selling my bags of junk coins many years ago. But it's a different animal from gold, and it's got more positive economic correlation, industrial usage. It's a byproduct in many cases of mining for industrial metals. I think it's more readily available than gold above ground. And, this is where I credit Bob Hoy, because it's, just like old Turkey with the bull market, he called it a metallic credit spread. And to me, that's brilliant, because it really is. It allows us to look inside the market and find a very sensitive pre-indicator. So when the precious metal with more commodity industrial utility than the one with more monetary utility has, that interplay between the two of them is an early indication for other areas in the markets. So it's no surprise that commodities have not got off the ground generally. I know there are certain supply, demand, and geopolitical things in play right now that drive certain commodities. I'm thinking of rare earths in particular, which I own a couple of those for strategic reasons. But generally, gold is rising versus commodities, just as it is rising versus silver. That's all countercyclical, anti-inflationary signaling. And I'm also on watch for that to change. I think at some point silver is going to take over on this cycle, but it hasn't happened yet.
Yeah. Okay. I want to circle back to the macro.
Mhm.
Tell me about bonds and bond yields. How is that playing into your big picture view?
Primarily in the yield curve, or the two yield curves I watch, which is the 10-year and 2-year, and the 10-year and 3-month. The latter of which is more tied to the Fed, with the T-bill being more of a proxy for the Fed funds rate. I think the Fed actually exerts influence over the T-bill um, by sitting like it's sitting right now, undecided, not knowing whether inflationary pressure is going to kick up again with the tariffs, or the downcycling economy is going to win out, which I think is the play that is going to that has the highest chance of happening in the interim. I think the Fed will roll over, and so then the 10-year 3-month yield curve will join the 10-year 2-year yield curve, which is steepening into an economic bust signal. And we're in process right now. There's no set time when you hit a critical mass and it all falls apart. It may be falling apart right now. That first hit in the stock market may be the first shot over the bow. And then as far as nominal bonds go, I watch the 30-year yield and call it the continuum, because it was just, I'm a visual learner. I see pictures as opposed to data. And then I think about the pictures. And that picture was decades of a trend unbroken, a downtrend, a gentle disinflationary downtrend, unbroken, though there were several attempts, several rises to those moving averages that were repelled, and then the downtrend into further disinflationary signaling would continue until 2022. And so in 2022, I believe they blew the gasket, or the gasket was shown to be blown after they did blow the gasket in 2020 with that inflationary panic by both Fed and government, balls to the wall, inflation at all costs. And so I believe the bond market rebelled, and never to never to get back in line again. Although in the expected deflation scare, yields will drop, but then we'll be watching for support at those moving averages, whereas in the past we watched for the downtrend to remain intact. So that's why I think there's an interim deflation scare before the next inflation, which is going to be stagflationary and economically corrosive. There's a lot going on. I'm just a nerd and a geek with this stuff. So I don't want to confuse people, but that's what I see.
Well, you're plenty more than that and a musician, but again, that's another conversation. Yeah, I want to follow up on bonds, Gary. Were you surprised? We saw the market crash, quick 20% move down, or at least from the peak, down 20%. And the 10-year yield and the 30-year yield, they didn't dump. Was that a little surprising to you?
Yeah, it caught me off guard. I mean, I'm holding my short-term 0 to 3 year bonds, treasury bonds, without any problem through it all. It's all profitable on its, uh, you know, the net asset value of it, and as well as spitting out income, which is what I wanted it to do. I did try TLT, and that didn't work out. That was right into the jaws of this surprising spike in yields. So I offed that. Um, but I'm also not surprised because I can't pretend to quantify what's going on with the global trade and tariff war. Um, the easy answer is China and Japan dumped treasuries, but I think there's a lot more to it than that. And I don't know what the mechanics of it were. Like I said, I was speculating the other way, and I still think TLT is going to go up, and I think that yields are going to drop, and the yield curve steepener will be deflationary. But yes, I was surprised.
Yeah, along the same line, is it possible to have a, doesn't have to be a big deflation scare, but a real deflation scare? But the bond yields, they come down, long-term US bond yields come down, but they don't come down as much as you would normally anticipate. So yeah, in other
So
words, yeah, okay, I'll let you, yeah.
yeah, so I wish I could show a chart, but just picture that gentle downtrend over decades, and then those moving averages that limited the upside to yields, and that was broken. That was a decades old trend, and it just happened to coincide with all that bubble making, in my opinion. And that is busted. So, if we get the deflation scare that I expect, yields will drop as they used to in the old macro, but I don't think that we're ever going to see the levels of the past. I think the new trend is up in yields, and that's going to be very damaging. Um, but yes, we've been on a view of declining yields in the interim.
So declining yields, but because the continuum has been broken, don't expect like a move down to 1% or 2% or
No, I
0%.
don't think so. I think confidence is lost in the bond market, in policy making in general, in government. I mean, I know I'm being Captain Obvious here, but
Yeah.
it's that loss of confidence is being reflected in the US bond market.
Yeah. Well, I guess people are wising up on that. Um, yeah, we've already covered a lot, Gary. Um, okay, give me your view on the stock market. We've had this 20% decline, kind of a weak rebound. I mean, how do you see it? Do you think we could have more of a counter trend rally, or the market could just kind of hang in there for a while before the next leg down? I mean, what's your view of the stock market now, and how you see it playing out for the rest of the year potentially?
Well, my big view is bear market. I think we're on a bear market rally right now. And I did a video last week, a quick little thing with the S&P 500 showing that the market's still locked in that bear trend from the top. If it breaks a certain point, which isn't too much higher, I think it could test the highs. Um, I'm not shorting the thing. In fact, I was lucky enough to buy it, to buy the SPY just minutes before Trump opened his mouth and said the market that day, and the thing just shot up. I don't like playing that kind of game,
You didn't have you didn't have some inside information there.
Yeah, right. Donnie called me. We have I have a red phone right next to my desk here that so anyway, uh I believe it's a bear market, but the sentiment became so overblown, so terribly over bearish that it was a tinderbox waiting for a match. And so the match came along and ignited it. But to me, bear market right in line with the idea that the gold stock sector is counter-cyclical and should be unique from all this other stuff because it is benefiting fundamentally through counter-cyclical pressures. Well, that works the opposite way for the cyclical world, including stocks and economies. So I think we're in a bear market, but I think this rally, it came along to screw any shorts that are being greedy. And I don't know whether it's over or not. It got a little weak toward the end of last week. We could even test the recent lows. But I just feel that with the terribly overbearish sentiment that was registered, I think the market may have more upside before we resume the bear market. Although technically speaking, as just a TA guy, it has rebounded to a point that could easily contain the market. So we'll have to see what's happening on this pullback to see if it tests the lows and regathers itself. But either way, big picture, to me, it's a bear market. I just think, well, I know this was a tradable rally. I sold the S&P or the SPY, and now I'm just kind of watching to see what happens. But I'm not ready to short it. I'm not a great active bear player anyway, so I just need to make sure I know what I'm talking about with respect to bear market rally or the potential, which is still technically in play, that this is an ABC bull market correction in stocks. It's just not my favorite view, but it sure could work out that way.
Gary, as a man who stares at charts, let's wrap things up. I want to get your technical view on gold and silver. So gold, I mean, we have exceeded the 3,000 target, the cup and handle target, but what do you see now?
I see a rabidly bullish monetary metal. And I also see extremely overbought conditions. We were talking about a tinderbox and a match for the stock market. Well, gold is opposite right now. Any happy feelings, good news, something that pervasively makes people feel good could knock gold down $100 in a day, 200-300 bucks. But to me, it doesn't matter. We're in a new macro and it's a bull market. But as far as the miners go, that's where there'd be vulnerability and I'd want to be hedging at least. But again, old turkey comes to the fore and he says it's a bull market, you know. And I might have guessed when gold hit my target, it was just a 3,000 plus, which seemed, pretty unattainable a couple of years ago. It hit 3,000 plus, and I'm certainly not selling gold, and I didn't sell to gold miners. And it pulled back a couple weeks ago, a normal test of the 50-day moving average, along with other markets that pulled back sharply, including the gold miners, and then it shot up again. So I don't want to be in the position of, saying, "Oh, damn it, I was right, and look what I did. I took myself out of a great bull market." So I will try to hedge. I'll try to manage cash, maybe take a profit here and there, but I really only hold gold stocks that I really like. So I just have to think twice about selling. And you can think overbought. Well, overbought can stay in play for longer than you might think. And so that's the technical situation in gold. It's extremely overbought. Everybody knows it's bullish now. The momos are diving in, the FOMOs are diving in. Silver, bullish to me. in a much less spectacular way. I recently had a daily chart pattern, a cup and handle pattern get ruined conveniently after the silver squeeze fanatics took to the airwaves. It's like, thanks, guys.
Yeah,
But
next time that happens, we'll be on the lookout for an interim peak.
yeah, exactly. Well, that it was really just a few days, several days or whatever. But take a look at the monthly chart of silver, and I don't think you can call it anything other than bullish right now. So that's part of why I'm on the lookout for, regardless of whether the precious metals continue up or take a sharp correction, at some point, I'm looking for silver to catch up and to take leadership. And that might actually happen into the ending phases of the rally, if not the greater bull market. But that's really more information than I should be spewing out right now because it's really just a week to week situation. And gold is extremely bullish and overbought, and silver is due to play some catch up. But if we get that deflation that I'm expecting, the interim correction could be something to behold as well. And maybe that's what silver is indicating. It just won't take up leadership.
Yeah, maybe the gold silver ratio could blow out more to the upside. But I guess one follow-up, difficult question on silver. Is there anything we could look to, another indicator that might tell us that silver is getting ready to lead gold? I mean, aside from, the gold silver ratio, is there anything else that could give us a hint of when that might happen?
Well, if it's going to happen, I think it could happen now. Um, I don't know if you noticed the chart I included in last week's report where um, we had this recent tanking in the silver or yeah, the silver gold ratio. And then we look back at I think it was 2020, whatever the
Yes.
previous instance where it just utterly tanked silver versus gold. And then what happened? A moonshot to the upside. So I think if there were possibly a Fed panic or a government, reversal to try to bail out asset markets, I think silver, the way markets cruelly work sometimes, that could end up being another final plunge in silver versus gold before a reversal to catch everybody off sides. When silver tears ass, it really does so. Meanwhile, gold's just been grinding higher day after day, week after week. So keep an eye on silver.
I like it. Okay, Gary, before I let you go, please tell our listeners and our viewers where they can go to follow all your work.
Very simple, nftrh.com. And from there, you'll find that I just reinvigorated a Substack that I had started years ago and am now committing to along with my daughter who's helping. And, I want to really make the public content much more readily available on different mediums. And there's a lot of public content of value. And, we've pretty much been right about the whole macro. It's not a day trading website or enterprise. It's more intermediate term, but we will be right at every phase on the macro, even if I have to adjust and subordinate my ego and admit I'm wrong on a certain course. I think it's just a very sensible method of managing markets. So check it out, nftrh.com.
Oh, Gary, it's fantastic. I encourage everyone out there to subscribe. Pleasure to have you on and catch up, Gary. And I hope I can have you back again, maybe in a couple months, and we'll see how things are developing.
Sounds good, Jordan. Thank you again.